Hello, everyone. Welcome. S&P Global Ratings has revised its outlook on a number of NBFCs here in India, citing increasing risk from challenging operating conditions stemming from COVID-19 outbreak. Joining me right now in this discussion is Nikita Anand. She's the Associate Director at S&P Global Ratings to talk about the report. Nikita, thank you so much for joining in this morning. Let us talk about the rationale for this ratings outlook change that you set out for a number of NBFCs and to mention some of the larger ones that were touted to be the bellwether companies here in India.
Hi, thanks, Devina. Glad to join you guys today. You're right, we do see risks in the operating environment have increased. The economic activity on the ground has come to a standstill from COVID-19 related containment measures, and we have therefore taken some rating actions to reflect the possibility of deterioration in asset quality and profitability for some of the banks and NBFCs. We must note that while the Indian banks are not entering the slowdown from a position of strength, they have been on a recovery path for the past 12 to 18 months. They were showing some improvements in non-performing loans with better recoveries, lower new NPL formation, but this economic slowdown will defer that improvement by a year, in our opinion. We do expect the overall impact on the NBFC sector to be more pronounced in the banking sector, given some of them tend to lend to weaker customers. And we must also note that since September 2018, after the IL&FS default, the funding conditions for NBFCs had tightened, and they were anyway seeing slowdown in growth and lower profitability since then. So they are also not entering this from a position of strength. So that's why we see that the risks have risen, and our negative outlook signifies some of the risks that can play out over the next 12 to 18 months.
How significant do you think the damage is going to be on asset qualities, and within the NBFC space as well? Which of the pockets are going to be affected the most? I know you spoke about microfinance lenders because they lend to the weaker sections of society. The collections are expected to be weaker. But aside from that, consumer finance, consumer financier like Bajaj Finance, the big one there. What has been the rationale behind bringing down some of these companies in terms of your rating out?
Right. So in terms of pockets of stress, as you rightly mentioned, microfinance is amongst relatively more riskier segments, given the income profile of the borrower itself is inherently risky or weaker, and there is a huge proportion of cash collection. Apart from that, on the housing side, we see affordable housing as another portion that could come under stress because, again, the lending is to people who come from a weaker strata of the economy. Otherwise, mortgages on the whole should be relatively low-risk asset class during this stress period. Commercial vehicle a bit more vulnerable because they were anyways, again, notwithstanding COVID, seeing some softness with the slowdown on the economy anyways. In terms of retail loans in particular, I think there we have to make a distinction that large-scale job losses or mass unemployment is something which can bring about some stress on the overall books of the retail portfolio. In particular, the unsecured piece or the personal loans piece and the credit cards piece could come under stress if we start to see losses happening. Otherwise, it will depend upon a company-to-company basis. If the exposure of a particular company is more towards the salaried class and the salaried customers also are more from better rated companies, I think then this is a more resilient profit borrow profile as compared to say if it's linked more to the smaller industries and SMEs and more on the unsecured small ticket lending space.
All right. So this particular crisis is definitely going to separate the men from the boys. Nikita, I want to ask you something with regards to credit costs, liquidity availability. Who stands to benefit now? Obviously, we've got the stronger ones that have better credit lines available, and therefore they'll be able to weather this a little bit better. But for them also, the stresses that come along with this 3-month moratorium, is going to be pretty evident. So, how have you read into how each of this changes with variables like credit costs, liquidity, credit line availability? Put that into perspective.
Right. Liquidity is definitely a the important point now from a rating perspective, because as a large proportion of borrowers opt for moratorium, cash inflows for these finance companies may be limited, which will make them dependent on either the liquidity buffers they are holding onto their balance sheet in the form of cash and unutilized bank lines, or refinancing to service their upcoming debt maturities. And I think there will be a big differentiation between the better quality companies versus some of the smaller and weaker companies. The NBFCs that we rate, and you'll note that we rate some of the large ones, as you pointed out earlier itself, we think they have sufficient liquidity at this time. They have liquid assets, undrawn bank lines, and in some cases they have funding lines from group companies also. And I think that is also a very important point. As markets get more risk averse, there will be a differentiation between companies with better credit profiles and companies who have some kind of corporate or government backing. And the differentiation will increase with regards to where the market sees, some kind of stress building on the asset quality in terms of higher NPLs and credit costs panning out in the next few quarters, or there is a perceived weakness in management and governance coming up, or, there were inherently sort of, say, players in markets which were anyways under pressure, like real estate and wholesale related companies. So I think that differentiation will increase. Banking sector, of course, has a huge amount of liquidity. I think RBI has done a lot there with the targeted long-term repo operations as well. I think some of the larger NBFCs will benefit. The last round, some of the smaller, better profile companies can also benefit, but the weaker ones probably will find it a bit more difficult from both liquidity as well as refinancing perspective.
Bajaj Finance in particular, obviously, it has its own benefits being linked to some of its other, the common brand name that it has with some of the other companies like Bajaj Auto, Bajaj Holdings. Now, if you see, the credit profile of these companies deteriorating, will that likely also have the impact of the ability of Bajaj Finance to maintain that liquidity position in order to wither this particular period? Because the management themselves has highlighted, first they put out a scenario, they put out 3 scenarios in their conversation. The first one is if the lockdown would have been lifted as promised on April 15, then normal operations would have started by September, like getting back into shape. But that didn't happen. The lockdown got extended to May 3rd now, which pushes back recovery another 3 months. So in light of that, what is the probability of the credit profile getting hampered for Bajaj Finance and therefore its ability to get those credit lines?
Right. In terms of probabilities, Devina, our outlook is negative, which basically means there is a 33% chance that the ratings on Bajaj can go down over the next 12 months, say 12 to 18 months. And we do see some pressure on asset quality and profitability, both from the the rising risks in the operating environment. So that is one. Of course, Bajaj has been a group which is very focused on, which has been always very focused on risk management. So their ability to manage the risks could be better than some of the peers, and that's why we did not pull the trigger today. But we do see some possibility of a deterioration over the next few quarters. In terms of group companies, I think again. The Bajaj brand name is very important. So Bajaj Finance as a company does, in our view, accrue benefits from that brand name in terms of both funding access as well as its its dominant position in the market in India. And any deterioration in credit profile to any of the group companies, say its sister concern Bajaj Auto or the ultimate parent, which is Bajaj Holdings, is a key downside trigger in our opinion. So we will be very keenly watching out on those parameters as well with regards to some of these NBFCs who are related to broader group companies, because common brand name and sharing and reputation sharing, it does accrue benefits in good times, but sometimes when there's a stress scenario on one of the group companies, it could relate to stress on the other related companies as well.
Yeah. Okay, so 1 in 33% chance of a downgrade on Bajaj Finances, while keeping in mind all those various parameters that Nikita just highlighted for us. Nikita, let's talk about some of the other pockets within the NBFC space. And we were in conversation with the management of Muthoot Finance, and Mr. Muthoot himself was extremely optimistic. He was pretty happy about the fact that they can gradually start operations in their 5,000 plus branches. And for him, he said his loan to value is just 50% right now, with the goal that they have versus the loans that they've given out. So they're in a very comfortable spot. So what's the call on some of these gold financing companies?
Right. So I think the opening up of NBFC services is definitely good, and it gives them an avenue, not just Muthoot, overall at the industry level, it gives them an avenue to sort of start to come back on track by opening their branches 20th onwards. However, I think for some time the focus will be on managing liquidity, managing collections, managing asset quality rather than growth. I think at this point, growth does come second in taking order, and managing some of those key credit factors becomes very important. With regards to gold finance companies, yes, there are some mitigants in place. In fact, gold collateral itself is a mitigant in place in a downside scenario, but we have to be the thing is, it's a very evolving situation, right? Unprecedented times. We are also almost on a very regular basis sort of updating our forecasts, updating our understanding of what's happening on the ground. So risks remain on the downside. And that is what we've sort of reflected on a negative outlook. There are some inherent strengths in a lot of these companies, and we have reflected that in our ratings, but the risks have tilted on the downside with the operating environment becoming more challenging.
Okay, what about housing finance companies? I know much of the housing finance loans are for salaried class, so they will see those AMIs coming in. But for a majority of the proportion now, if you start seeing job losses, salary cuts, it's going to be difficult to meet the obligation then, and therefore there are a significant risk that is there as a challenge for some of these housing finance companies as well. So, what is your assessment of them?
Right. For housing finance companies, I think clearly affordable housing would be impacted, which I sort of alluded to earlier also, because the profile of the borrower itself is very different. They are coming from a different strata of the economy, a bit on the income and salary profile, and hence they would see some pressure at this point in time. Largely, housing finance companies or mortgage loans, the collections also don't happen in cash. The collections sort of happen on an auto debit basis, and these are largely to salaried people. So as an asset class, they should perform better than other asset classes. More so given there is it's a secured asset class. So losses given default should also perform better or should be lower than other asset classes. Now, within the housing finance companies, it then depends on your different, what kind of exposure the company has. If the exposure is more towards affordable, or if the exposure is more towards, developer loans and loans against property, that segment is much more under stress than compared to, say, it's pure individual housing loans. These are salaried customers, and these are mainly from, better rated corporates or slightly larger corporates. This segment is much more resilient. Even in a job loss scenario, it will start to happen probably at the lower level more than, say, job losses happening at a large scale level at a large corporate.
Mm-hmm. Mm-hmm. All right, so that's pretty much the entire NBFC pocket right now that we discussed. Just one last question, Nikita, and can't let you go without asking you about your ratings outlook call on two private sector banks, as well as Axis Bank, ICICI Bank. Now, while obviously you have said that HDFC Bank and Kotak Mahindra Bank are better placed, have a stronger asset quality, and are able to withstand this weakness in the operating environment better. Are Axis and ICICI at a significant risk, or do you think that they have the capability to manage?
That's a very pertinent question, and I think for us also, that's how we have sort of differentiated between the outlooks. So first of all, if you see, Kotak and HDFC are sort of entering this period from a relative position of strength vis-a-vis Axis and ICICI. So they are HDFC and Kotak both largely retail-oriented banks, very less exposure to long-term project financing, and hence the last, corporate blow up that we saw in the Indian banking sector, these two banks were relatively unscathed. They were performing amongst the best in that peer set, whereas Axis and ICICI saw some weakness. They were, of course, slightly better than their public sector counterparts, but they saw some weakness in their asset quality. So relative position, again, is very important here. So they are entering on a slightly higher stock of stressed assets as compared to HDFC and Kotak. We do believe that there is a chance that they perform better than the industry in this economic slowdown as well. And we have sort of taken that into account. That's why we've only changed the outlook at this point in time. We do see some pressure, but we do see a possibility that they would be able to manage a slightly better than industry asset quality during this time as well.
Okay. Got that. That's encouraging to hear. Nikita, thank you so much for joining us this afternoon with your thoughts. Appreciate it.
Thanks, Divina. Good talking to you. Take care.
Thank you. Bye-bye. And viewers, thank you so much for logging in.